Okay, so it is 11 o'clock, so we will go ahead and get started today. Good morning, everyone, and welcome to our Everyday is Earth Day webinar series hosted by Emerald Built Environments. We've got a wonderful conversation set up for today, and we're excited to get started. As we are now into the month of April, and with Earth Day and Tax Day right around the corner, our topic today is appropriately focused on tax incentives for sustainable design. My name is Michael Fodor. I'm a project manager here at Emerald. I primarily lead multifamily certification projects and sustainability consulting projects, but today I'm your webinar host. A few housekeeping items to start. Please feel free to ask questions in the Q&A feature during the presentation, and we will save some time at the end to get to them all. We are recording this webinar and we'll make it available to registered participants as well. So today our host is founder and managing member of Emerald Built Environments, Laura Steinbrink. Laura has an unparalleled understanding and passion for sustainability, and how we can all make a difference in the design, construction, and operations of all building types, including, for today's topic, how to leverage tax incentives for sustainable design. And our special guest today is Craig Miller, president and managing partner at Duffy & Duffy Cost Segregation. He is a CPA, has a deep level of expertise and extensive experience in his role as a trusted advisor and business partner, assisting CPAs, tax professionals, and businesses as they navigate the complex and ever-changing tax laws that impact commercial property development and ownership. With that introduction, I will turn it over to Laura to get started with today's presentation.
Awesome. Thanks so much, Michael. And just a quick introduction of Emerald and of Duffy & Duffy before we get started. Emerald is a sustainability consulting firm. We work across the United States and internationally. We're very proud of our B Corp certification and our carbon neutral status, which we achieved in 2022. We are actively focused on our own 2030 goals, and our goal is to enhance 2030 sustainable environments, and are pleased to announce that as of April 1st, we are at the 1477 number towards that goal. Everything that we do at Emerald follows what we call the Emerald way: listening and strategizing, evaluating and planning, implementing and testing and measuring. And these webinars really help us connect with our clients on things that are important to them, that help support the listening and strategizing efforts that we do with them. Craig, do you want to give us an overview of Duffy & Duffy? You're on mute.
Yeah, that would help, right?
Yes.
So I'm glad to be part of today's webinar, and I appreciate the ongoing friendship and business relationship that Laura and Emerald Built Environments has. Just a quick intro. I was not involved in green building prior to 2008. I had written a column in Properties Magazine in Northeast Ohio about the Energy Policy Act and the commercial building tax deduction under Section 179D. And after the article was published, former U.S. Green Building Council chapter president in Northeast Ohio, Elaine Price, calls me cold and introduces herself and says, "Hey, I read your article. I'd like to meet." And I said, "Who are you? who are you with?" And fast forward 14, 15 years, I'm a past board chapter director for the U.S. Green Building Council chapter here in Northeast Ohio, and currently serve on the regional leadership team for the state of Ohio. So that's just a little interesting history of how I got involved with both the U.S. Green Building Council, but also becoming a advisor to businesses and CPAs and tax professionals as it relates to green and energy efficient building construction and operations. So I've been with Duffy & Duffy Cost Segregation since 2007. Duffy & Duffy was the very first cost segregation firm in the state of Ohio. We do have a national presence. We've conducted studies now in 40 states. We added the energy efficient tax savings deduction modeling and certification in 2009. The Energy Policy Act adopted in 2005. We were already meeting with building owners and gathering blueprint plans and specs for cost segregation studies, and it was a natural fit to educate and provide taxpayers with the energy efficiency tax deduction that the tax code had put forth in the 2005 Energy Policy Act. So cost segregation studies and the 179D energy efficient tax deduction fit well together and complement one another. And there's an interplay there. And we assist owners and their tax advisors on how to maximize that income tax savings. And the bottom line is, why does Congress put tax incentives in the tax code for the benefit of business? Well, they do it to incentivize investment. They do it to lower the cost of capital. And, the critics will say that, well, you're giving tax breaks to corporations. Well, the design, build, construction, and the operation and maintenance of buildings employ a lot of employees in owner-occupied space, but also leased space for businesses of all sizes, and spend a considerable amount of money for electric and gas utilities, but also on operations and maintenance of lighting and heating and cooling systems and everything that goes into operating a building. So Congress has recognized that commercial property owners will spend and hire and invest and build the tax base, and they reward them for that by giving them some tax incentives. It's not free money in the form of grants, but it is incentives in the form of either deductions or full tax credits. So that's kind of a high level overview of what we offer.
Awesome. Well, and it is very true. I'm glad that you brought up our longtime knowledge of each other and working relationship. And I'm thrilled to have you here today to have this conversation with us. Because I know at Emerald, we traditionally deal with major construction and new renovation. And you, I believe, if I'm putting words into your mouth, have clients who also will just approach this work through what we call the one-off projects, the boiler replacement, the lighting replacement. And so much more of a tactical, we need to upgrade a piece of the puzzle as opposed to the major renovation and new construction. But these concepts can apply across the board. And so I wanted us to have that opportunity to really present what's out there, what's new, and what are the high level changes that have occurred since the recent legislation came out. So I think the four things that we're going to talk about is that renewable energy credit, the 179D, the 45L, and the new CARES and IRA changes that came from it, and leave people with some to-dos, hopefully some new information, and maybe some incentive to make some changes that they've thought about. So why don't we talk about the renewable energy credit? Give us the sort of history and background, and feel free to go into more detail about it than we've captured here in our slide, and just spend a couple minutes telling our audience about the opportunities here.
Sure. Without trying to be too technical, I don't want to overwhelm our attendees today, but in the tax code, Congress has had several investment tax credits that date back to the late 1950s for all types of business investment. And the Energy Policy Act of 2005 brought on an investment tax credit specific to commercial property and commercial building ownership. There still are production tax credits for large scale solar and wind and other alternative energy sources on a large scale. So there's production tax credits for larger industrial projects, but also investment tax credits. And taxpayers who have made the leap to what the tax code defines as energy property in code section 48 of the tax code. Energy property covers solar panels, it covers small wind and micro turbines, geothermal heating and cooling, fuel cells, waste recovery, combined heat and power. And since 2005, taxpayers and business owners have had the incentive in the tax code as authorized by Congress for a full tax credit of anywhere between 10 and 30% of the all-in cost of that investment, to lower that first dollar cost, lower the cost of capital. And on top of the tax credit, Congress has defined energy property in section 48 of the code as personal property. So even though geothermal heating and cooling that is beneath the ground, you wouldn't think of as personal property or necessarily removable, it doesn't matter. The Congress has said solar and wind and geothermal and combined heat and power and fuel cells are all personal property, which means they have a 5-year depreciation life instead of a traditional building depreciable life, which is a very long 39-year depreciation recovery period. And that 5-year property has been eligible for this bonus depreciation, which Congress has adopted on and off since 2001. And for the last 5 years, under the Tax Cuts and Jobs Act in 2017, all personal property for businesses of all types, whether it be machinery and vehicles, equipment, tools, computers, furniture, those are all examples of business use assets bonus depreciation eligible, but so has the remaining basis after applying the tax credit for renewables. You get the first year bonus, which was 100% write-off of the remaining basis for the last 5 years. And then this year, the bonus is still 80% of the remaining depreciable basis after claiming the credit. And the bonus is going to continue for the next 5 years, although it will phase down 20% each year. The Inflation Reduction Act that was passed last August added for the first time to the Section 48 tax credit energy storage, including thermal energy storage, dynamic glass, microgrid controllers, biogas, and linear generators. Solar, the solar, speaking specifically of solar, was an investment tax credit of 26% from 2020 to 2022, and it was supposed to go down to 22% in 23 and 10% in 24. I'm happy to report that Congress in the Inflation Reduction Act last year did extend the energy investment tax credit through 2023. So that's a 10-year extension.
2033.
2033, 10-year extension, and potentially made the investment tax credit a full 30%, provided that certain requirements are met as it relates to prevailing wage and apprenticeships. So the incentive, the first dollar cost is reduced, and the after-tax cost of these projects is much less.
Right. So the short story is any project that is considering one of those laundry list of things that you talked about, everything from controllers to geothermal to solar to wind to everything else you said, right? Storage, battery storage, those are all eligible for this credit. And so it's an invitation for companies to really look at what are they doing and what's the investment and where can they win with, using this tax strategy, right? So let's go into 179D, because I know this one's just as deep as the other, and you could talk for an hour on each one of these probably with no problem. And we want to, keep ourselves probably within another 10 minutes of this presentation before we open it up to questions. But give us the overview of the who is eligible for 179D, because I know those have changed recently, and then the very high level of what is eligible.
Sure. So in the Energy Policy Act of 2005, Congress and the Department of Energy had some statistics as it related to the cost and operation of commercial buildings throughout the United States. And commercial buildings in the United States, just some quick stats, the non-industrial building sector uses 41% of total energy in the United States. Commercial buildings, of that, 19%, residential buildings, 22%. The non-residential building sector uses 50% of all electricity generated in the United States. The recent surveys show that 35% of tenants in leased space cite clean and green buildings with quality indoor lighting and indoor air quality as their primary reason for retention and attraction in tenant space in commercial buildings throughout the United States.
We can double down on those statistics, and we're seeing it. So, I mean, especially coming back after COVID, corporations, right, left, and center we need to redo our space and make it healthy for people. And healthy means access to good lighting, controls, thermal comfort, air quality, and all of those elements sort of bubble up into what's eligible in 179D, right?
Exactly. So, 1 in 3 companies that have tenants in lease space, and this is growing, are citing, the number one reason, or number one thing they're looking for to either renew their lease or to move into new leased space is cleaner, greener, energy efficient buildings within, especially indoor air quality since COVID. And there's some really neat new technologies as it relates to ion technology and ultraviolet light and scrubbers and filtration for indoor air quality that reduce, COVID and molds and SARS and airborne viruses and airborne bacteria. And as it relates to, building ownership, for selfish reasons, owners and executives and employees want comfort and clean and green space. It's a lot of companies more and more have in their mission statement and in their annual reports what their sustainability goals are, short and long term, and they believe in having a mission of corporate profit and principles surrounded by and coupled with sustainability initiatives. The goal of the Energy Policy Act of 2005 was to reduce carbon and greenhouse gas and nitrogen emissions by 30% by 2030. And, the US is doing a much better job than the rest of the world in terms of making buildings more energy efficient. But there's still a long way to go. I think statistically.
Let's bring it, Craig, let's bring it back for a second, just straight to 179D. So commercial property owners, right? And then also, if there's higher ed or government projects, nonprofits working on it, they can assign that deduction to the design team, right? The designers of record.
Yeah. So if anyone's on the call today who is a design professional or works for an energy service company, so think Johnson Controls, Honeywell, Siemens, many for-profit taxpayers have taken advantage of the tax deduction themselves as a for-profit business building owner since 2005. But in the Energy Policy Act, there was a carrot or incentive for the designer of record, the design team who is working with federal, state, and local government building owners who can't use the tax deduction because they don't file and pay income taxes, to get a one-time written assignment to the designer or the design team for federal, state, and local government building owners only. Excluded from that, prior to the Inflation Reduction Act last year, excluded from that was the not-for-profit building owner, like a Cleveland Clinic or a UH or Oberlin College. But going forward, beginning in 2023 for the first time, not only is the 179D deduction permanent, okay, not temporary like the bonus depreciation, not temporary like the investment tax credit that only goes through 2033. The 179D deduction is permanent, and for the first time starting in 2023, can be assigned to the designer of record, whether it be an engineer, an architect, design team, can be assigned by a not-for-profit building owner, just like a government building owner.
Right. So I just want to be mindful of our time because we've about 4 minutes left of our planned time before Q&A, and we need to get to a few more topics. So on this particular overview of what 79D is, let me tee it up and then you give us just a couple thoughts before we speed up into 45L. But this is an income tax deduction, and you talked to us a little bit about that. Income tax deduction, and it's ultimately calculated based on an energy model, right? The project has to employ an energy model. There's certain requirements for the model, and we can, maybe address that in the Q&A if people have questions about them. But before 2023, it was up to $1.88 per square foot based on what was contributing to it. And 2000 and beyond, it could go up to $5 a square foot, right?
Right.
And
what was nice, and the wisdom of the Energy Policy Act was that it made the energy modeling in Department of Energy prescribed modeling software a level playing field where everyone would model against an ASHRAE baseline reference building in the software. And there was no requirement that electric and gas bills be hunted down and all that information and usage through the meter be keyed in. The energy savings, which was either designed or actual, and those terms are actually in the Energy Policy Act public law bill that Congress passed, designed or actual against the ASHRAE baseline reference software model. And there was a little bit of a difference between a retrofit and a new construction, but the same modeling steps would be taken, and provided that 50% energy reduction was achieved against the 2002 baseline reference ASHRAE building, taxpayers could get a square footage tax deduction for what would otherwise be 39-year depreciable life HVAC and hot water, or for what would otherwise be 39-year window seals and doors and insulation and roofs, and the same with interior lighting.
right. So then that whole piece of the puzzle, 179D, was for commercial office buildings and multifamily above 3 stories, but we don't want to leave the single family house, the home builders, the low-rise residential, including affordable housing, condos, student housing, assisted living. We don't want to leave them out of the puzzle. Like, that's what Congress said. So they have their own framework, and that's under 45L, right?
Right. So in addition to the 179D tax deduction, Congress put in a full tax credit under Code Section 45. And it was an incentive for a residential home developer, builder, or for a multifamily larger apartment building owner to specify higher efficiency systems and give a full tax credit, potentially up to $2,000 per dwelling unit. So a 50 unit apartment complex would be, 2,000 times 50 doors, 50 units, a full tax credit. And this also required specialized energy modeling and certifications to claim the credit. And unlike the 179D deduction, which did not require any special IRS forms to be filed with a tax return, the 45L credit did require a special IRS form to be attached to the tax return. So residential subdivision owners, if they built and sold, the key was they had to build and sell. It couldn't be unsold inventory. They could claim the $2,000 credit for a new dwelling unit through 2022. And then beginning this year, this credit is potentially expanded, potentially up to $5,000.
Right. So we just we're actually into our Q&A time. So we just want to do these two quickly. So we know also, and we've talked a lot about referencing back to the Inflation Reduction Act, and the CARES Act also came out with some opportunities, and there are credits for EV fleets. There's credits for EV charging stations. And also there's the provision for this green bank that can provide low cost financing that's coming out as well. And I know green banks are being formed around to deal with those lending opportunities, but just can you give us a minute or two about the importance of this modeling and how it influences, how the overall, as you call it, construction tax planning helps with value engineering? And then Michael will tee you up for questions.
Sure. In my 16 years with Duffy and Duffy, I'm surprised how often I hear stories from CPAs where they find out after the fact that their client constructed a new $10 million building, or they found out after the fact that the client undertook, a building addition, expansion, and renovation. And what happens a lot is the owner gets together with an architect or a design build contractor and a bank, and they set a budget, and they don't upgrade to higher efficiency lighting. Although I'm happy to report anymore with LED lighting being 50% less than what it was 10, 12 years ago. Every project is spec'd with LED lighting, and the LED lighting
right.
qualifies. But I'm surprised how many building owners, and this is commercial, industrial, institutional, retail, restaurant, you name it, multifamily, how many just spec standard efficiency HVAC and standard efficiency window seals and doors. So not only are they missing out on the monthly and annual energy savings through the meter, but they're missing out on additional tax shielding that's available in the early years of building ownership.
Yep, absolutely. And we see that, I mean, it's not that much more, right? You want to get to net zero. Okay, maybe you're talking about a different equation. But again, we've just gone through an entire presentation of how that could be offset with some deductions and some credits, and depending on what kind of the building type. So Michael, do we have any questions from the panelists or from the audience?
Yeah, so we just did get a question in a couple minutes ago for Craig. How did the partial deduction levels change under the new version of 179D?
So good question. The Department of Energy released the tables recently, where in the original Energy Policy Act, it was very strict and very difficult to get the lighting and the HVAC deduction, because you had to achieve 50% energy reduction. Well, many in the real estate community, the American Institute of Architects, the American Institute of CPAs, the Real Estate Roundtable, NAP, and others lobbied Congress and the IRS to reduce the energy requirements, and something called the interim lighting rule came out in 2008, and that allowed for a partial deduction. And then in 2012, a partial deduction was approved for HVAC and hot water. So now instead of achieving or being required to achieve 50%, the minimum reduction starts at 25%. But the square footage deduction jumps from 63 cents a square foot to a minimum of $1 a square foot. So the more square footage, the higher the deduction. Just a side note, the deduction cannot exceed the all-in cost of the energy efficient property. So if the building is 1 million square feet, potentially, you can't get $5 a square foot on the max for prevailing wage and apprenticeship on 1 million square foot building, unless the cost of the energy efficient property was that much. The deduction is capped at the amount of the energy efficient property all in cost basis, and that does include design and permitting and engineering. So it's easier to get the deduction. And quickly, there's an alternative certification and modeling that is for the first time available this year, where instead of modeling against the ASHRAE baseline reference building, taxpayers have the option now of using performance-based energy usage through the billing, through the meter, and then after a 12-month review and certification by an engineer or architect, a building owner who either builds new or retrofits can claim the deduction in the following year under this alternative method. And that's a first-time opportunity that was not available prior to this year.
Wow, that sounds like something we should dig into a little later sometime together. So Michael, I know we're, and you're moderating us, but I'm jumping in. We're a little bit past our time. And I don't know if we had any other questions, but we could stay for a little bit. I know some people might want to go, and you want to give the whole, this will be,
Yeah,
up there.
Yeah, so as Laura mentioned, we are running a bit low on time. Please do feel free to reach out directly to our speakers with any additional questions using the contact information that you have on the screen. Thank you, Laura. Thank you, Craig, for a wonderful webinar today. That does conclude our official program, but as Laura mentioned, we can stay around if there are any specific questions that you'd like to talk about now. Stay tuned, please, for additional webinars and additional educational opportunities coming from our team as we continue to move through the spring and into the summer. So thank you all.
Okay, Craig, before we go, we could do an outtake. I mean, maybe we should add some music here. We don't have that going right now, but we could pretend like we're in the reel after the movie. So you just said what you said. We had the 30 minutes or 25 minutes of presentation that we had. You're the professional and you know what people ask you. What's the one thing you didn't say that you think everybody needs to know? And we'll wrap it up with that.
Well, I've been a licensed CPA for 27 years, and it surprises me that CPAs and tax professionals don't take the time to educate themselves about any of what we discussed today. So my advice to the business or building owner out there is, don't assume that your CPA or tax professional is up to speed on this. And if it makes sense, to bring in some outside parties, whether it be Emerald or Duffy and Duffy, we're not looking to replace your CPA or tax advisor.
Yeah, no, that's a hard no.
But don't assume that they are up to speed on this, because in my experience, I would say maybe 1 out of 10 CPAs and tax professionals are knowledgeable about the 179D and 45L and cost segregation.
Okay, I think that's great. And that's, not to steal the thunder, but that's the same thing we say at Emerald. It's like architects and engineers know how to do what we do, but there's a specialty, and we can hold the space for the, you know, difficult questions and the detail oriented so that they can be great at doing what they do. Right. And so we're just a complement to the team. And Craig, I want to thank you for being with us today. And Michael, thanks for your efforts in that. And I guess this is a wrap, right?
Yep.
Good. Thanks,
Wonderful.
everybody.
Thank you.
Bye.